Hey everyone, welcome to Beyond. Be sure to hit like and subscribe so the algorithm can find the show and provide the content for other people that may be interested. Today we have a very special guest, Michael Faught, who's a managing partner at Technology Capital Partners. We'll refer to Technology Capital Partners as TCP throughout the conversation. Michael, welcome.
Hey, Ben, how are you? Thanks so much.
Yeah, I'm doing great. Really glad to have you and really talk about the journey you're on and some very unique perspectives you've gained in your experience. And before we jump into sort of the Q&A, kind of give us a background on your professional background, if you don't mind.
Sure. Well, I'm from the East Coast originally. I actually grew up in Connecticut after my family came back from Europe, and I was 10 years old and came back to the U.S. speaking only Italian. So I've almost got English down. So grew up in Connecticut, went to college at Harvard, got a degree there in economics. Then I went to work for a big bank, and then went to business school in Philadelphia at the University of Pennsylvania at the Wharton School. And from there went to Wall Street. And then from Wall Street, it was industry, from industry to this technology incubator, which is really sort of what spawned this strategy that I want to share with you today.
So you really have an interesting, diverse background, but certainly on the financial side, Wall Street, with industry. And it sounds like early on, you really got a lot of experience in how to put deals together. Is that fair to say?
That is fair to say, yes.
Great, great. So at TCP now, or Technology Capital Partners, you've identified a very unique strategy for value creation. And when you think about value creation, whether it be from venture capital or angel investors, they often think about we make the investment, someone's already identified the technology, and we infuse the capital or the company an opportunity with enough capital to get it across the finish line. But in your case, you really have a unique strategy and approach. So what is the backstory and the origins of the strategy?
Sure. Well, the punchline, really, how we describe what we do is sort of two taglines. We are investors of technology rather than investors in technology. And hand in hand with that is this notion of why build it if you can buy it. And so I'll give you a little bit of context for where this came about, because when I left Wall Street, I was an investment banker in corporate finance and mergers and acquisitions. I then went to Allied Signal, which is now Honeywell, by the way. They merged. I was director of operations analysis over our $3 billion materials sector. And at Allied Signal, I crossed paths with a Wharton classmate of mine. And in fact, when I left business school and I went to Lehman Brothers, he went to McKinsey. When I went to Kidder in M&A, he went to General Electric. And then we sort of converged again at Allied Signal in New Jersey. And he's the one who invited me to join him at this technology incubator in Princeton. And I was a little bit confused because I had no experience whatsoever in commercializing technology. And I said, well, I don't know why you'd want me to be a part of this. And he said, well, no, he said, we'll handle that. You'll be our in-house investment banker. And after we have partnered these technologies in a licensing deal or a joint venture or whatever with these big corporate partners, your job, after we have created some equity value, is your job will be to raise dilutive capital. And so I thought, well, fine, I can do that. So and the rest of the team in Princeton there were a group of intellectual property attorneys, licensing executives, PhDs, consultants, a really smart bunch of people. And I was the only sort of investment banker in the place. And so I came into this environment with a very sort of naive, clear ability to evaluate what was going on and really just sort of assess it without any preconceived notions. And what I saw was a lot of really compelling technology not getting commercialized. And I didn't understand. It was confusing to me because I was seeing really compelling technology be dismissed or outright undermined by companies that themselves weren't that compelling. And it didn't make any sense to me. And I was frustrated by the experience because I knew that these technologies, we call them portfolio companies, but they weren't companies. They were a technological asset with a PhD or an engineer, entrepreneur attached, but they weren't companies. And so of the 50 or so that we had in our core portfolio, about a dozen of them were fully baked. But it was that experience of observing how technology largely doesn't
goes untapped.
I beg your pardon?
Goes untapped.
Yes, yeah, it's compelling technology. It's ready, but it never sees the light of day for some reason.
So,
And
Mike, let me understand something real quick. So, when you saw these portfolios of technologies in these companies, were these technologies that were acquired from smaller startups, or were these technologies that were actually developed in these big companies?
yeah, no, these were individuals. They were individual PhDs or engineers who had developed some technology, maybe at a university lab or a corporate lab or elsewhere. But largely, they were individuals with a technological asset, and our job was to help them commercialize it. And I was constantly watching these really, to me, compelling technologies not successfully entering the market, and it was frustrating to watch.
How would you guys pick winners and losers? I mean, a lot of great ideas out there, and I know companies will have the white space, the gray space. Meaning, white space, there's a gap between their offering, or maybe it's a gray space where it could fill a current offering.
Yeah.
How did you guys think about picking the winners and losers of technology?
Well, before that wasn't something that I was directly involved in, but the technologies that they did accept into our portfolio were very compelling technology. There was one example. It was what we called a smart bolt, and it had a piezoelectric thin film technology on the head of the bolt, which when installed with a drill that had the reader in it, you could, with very high precision, you could determine the load that that bolt was carrying. So that's very important when you're doing things like engine blocks and things of that sort, where you need performance, but you need to minimize the amount of weight. So they did a great job of locating really compelling technology. But what I was frustrated by was that in so many cases, the companies that you would think would want to license it or acquire it weren't interested. So we had to find a
So,
different.
so what drives this? Is it a risk statement where the company looking at it to acquire it looks at maybe there's regulatory hurdles, technical hurdles, getting into access or access to market hurdles? I mean, there's a number of hurdles. So, what was the biggest drags in these technologies seeing the light of day?
Well, it's interesting because my experience at Allied Signal, before I came to this technology incubator in Princeton, um, as director of operations analysis, there were three of us across a $12 billion company, and we reported directly to the executive management team. So we were the conduit between our executive management team and the business unit heads, in my case, in the materials sector. And what I learned from that experience was when you've got a $12 billion company and you've committed to Wall Street that you're going to grow it at 6% a year, you can't be messing around with individual technologies that might one day contribute $50 million in revenue, right? So a big company like that, and it doesn't have to be 12 billion, it could be 1 billion, right? But they can't be bothered. They can't be, it's just, they can't be distracted with little things. They need big acquisitions that are going to move the needle. So I think in a lot of cases, what I was observing with our technologies was with the big companies, our technology was too far away from really having an impact. And with the little companies, they either didn't understand the potential of the fit, which I think they did. In many cases, they were in some way threatened by it, and the thought of reconfiguring the way they did business was something that they weren't interested in doing, even though this technology could represent a competitive advantage relative to their peers.
Yeah, it's
So
kind of hard to move a Titanic when you got strategy, you got a corporate culture, you're going a certain direction, and trying to
right.
pivot and be nimble and quick is really challenging. So let's go back to the strategy you've identified. What is it, and
Yeah.
how is it unique versus how deals typically get done?
Yeah, well, let me describe how it came about, because this is not something I cooked up on my own. It actually evolved from work that I was doing with Bain Capital at the time. So I was looking at all this technology that I felt was really compelling and watching it not successfully enter the market. So I started thinking, okay, maybe there's another way to look at this. Remember, I came in from as an outsider into this world of technology commercialization. And in retrospect, I think that was an advantage, right? Because I didn't have any preconceived notions about how things get done. So I looked at our portfolio and I thought, oh, okay, so what we really have here is an assortment of catalysts for growth with maybe an engineer or a PhD attached that lack infrastructure. And I thought, so who has a collection of infrastructure that maybe lacks growth potential? And could we maybe find a way to put these two things together and be successful? So So having gone to college in Boston, I knew people at various venture firms and private equity groups. And Bain Capital was particularly intrigued by this because what I said was, I want to look at the orphans in your buyout portfolio, your smaller ones, and look at our immediately deployable technologies and see if I can't find a fit between one of our technologies and one of your portfolio companies that maybe has been surpassed and therefore it otherwise you'll never exit because it's just sitting there, and see if we can't create a growth story that will enable an exit. And Bain was particularly intrigued with this, and we started working together. We had one, in fact, that we were working on in ceramic bearings, when it was actually Bain Capital that approached me and said, Michael, we think there's greater potential here than exiting old deals that are hung up. And I said, well, what, enlighten me. And they said, we think that we could collaborate in the pursuit of new acquisitions in conjunction with your group who sources what they call the silver bullet. They said, you guys identify the silver bullet, you identify it, you qualify it, you strategically position it, and then we will jointly acquire some operating business whose product or service this technology can unfairly advantage. And I thought it was brilliant. And in fact, that was the first time they referred to it as technology capital, because we started thinking of technology itself as a form of capital, right? So we're now called Technology Capital Partners because we view technology as capital that can be invested in the pursuit of acquisition. So my point is that the strategy actually came from, unexpectedly, from work that I was doing while I was at this technology incubator, but working with a buyout shop. So it was, and back then when I did this the first time, it was widely recognized that technology and leverage don't mix, right? So the notion of technology in a leveraged buyout was not inconceivable, but it was just contrary to the way things were done. So it was pretty breakthrough thinking on their part. I just happened to be the one that decided to run with it.
Right. So obviously, when you have a new idea, a new approach, and people maybe haven't considered, or maybe they have, and in their mind think it'll never work, because a lot of people start off with that sort of presupposition. There's biases, there's paradigms that we all run with. So when you decided to take this on yourself, when all the experts said it would never work, why did you do that? Why did you decide that this was a good, path to pursue?
Well, it's funny because you're right. When I decided that this made sense to me, and it didn't make sense to my guys in Princeton, they were going, what the heck are you talking about? That's not what we do. And so I called my business school buddies and my Wall Street buddies, and they all said, you're going to use technology to buy companies? And I was like, yeah. And they said, well, that's ridiculous. That's not the way it's done. But, being stubborn, I guess, it made too much sense to me, having seen the investment banking side of the house, the technology commercialization side of the house, the corporate side of the house, and putting these three things together, I couldn't figure out why it shouldn't work other than that's not the way it's currently done.
Yeah. So what's interesting is you're using technology to develop these companies, create tremendous intrinsic value. However, it seems to me that the stage of the technology is really commercially ready versus an early stage startup or something that's sort of in the creation R&D phase. Is that a fair characterization?
Yeah, absolutely. And in fact, that's the key. We maintain, if this is the world of technology, that the venture capitalists are largely pursuing similar things. Right now, there's a lot of attention in artificial intelligence and Internet of Things and big data, and you hear all the same things very frequently. And we maintain that that's a fairly narrow band in the world of technology. So of the other 96%, let's say, 90 points of that is still developmental technology. It's too early. It's not ready. It's like in process. So that sliver of 4 or 5 percentage points is still a vast quantity of technology that is ready and it's disruptive, but for some reason it's struggling to find its way into the marketplace, and it's struggling to attract sizable capital because with regard to venture capitalists, they are constantly swinging for the fences because one or two deals can make their performance on their fund. So in a lot of cases, what we're looking at is to acquire a $50 million business that we can take to 200 or 250 and even more rapidly grow its cash flow, and then exit having created something that's large enough to move the needle. Then we can exit by selling it. It could be any number of buyers, but in this case, we're particularly focused on strategic acquirers, right? So, yeah, there was a lot of pushback originally, and the strategy here is that there is such a large quantity of technology that is ready but struggling. We refer to it in some cases as, maybe it's even been abandoned. The entrepreneur, the technologist has done everything right. He did everything he was told. He tried to license it, he tried to sell it, he tried to raise money, and was unsuccessful. Not because the technology wasn't compelling, but because it was deemed not big enough to be the next unicorn, right? And there's so much technology that fits that profile of ready but struggling, and that's our space. That's what we're looking for. And our philosophy, our strategy is, when we find technology that fits that profile, instead of raising small amounts of money, of venture capital, to begin to build a company around it, let's instead identify existing businesses who have sufficient scale to serve as a launch pad for the technology, but they're not so big that a single technology won't affect their growth rate, right? So,
Right.
so we're kind of, our sweet spot is sort of companies that are doing between 50 and 100 million in revenue. They are undifferentiated. They do the same thing the same way as everybody else. They don't have any competitive advantage relative to their peers. They're in highly fragmented markets, so there are lots of acquisition targets. And then the conversation that I have when I meet one of these technologists who has one of these technologies like I described, I go, wow, that's so compelling. What do we buy with it? And they always look at me like, what are you talking about? I'm trying to raise money. I don't have anything to buy anything with. And I have to sort of turn them around and get them to understand that we view that technological asset as a form of capital that can be invested and serve as the silver bullet, like Bain Capital used to call it. We refer to it as the needle in the haystack, right? So our mentality is, let's find the needle in the haystack, the technology that fits our description, and then identify the industry and vertical and acquisition targets that might benefit from the infusion of this technology. And
So in taking a company from 50 to 200 million, do you guys look to roll up similar technologies in that portfolio company to add to the value creation, or do you just like focus on one technology that can take it to 200 million? Or are you guys agnostic?
Yeah, it could be either. Let me give you an example. I have a really good example of how we would build something to sufficient scale, right? So this was a deal when I did this the first time, and I was trying to demonstrate, contrary to all my friends, that this did make sense. There was a deal that I came across, and I'll describe the industry first. But remember, we start with the technology. But in this case, what I learned was that there's a huge industry that relates to those big storage tanks at refineries. They might be 60 yards across. They hold, millions of gallons of gasoline or whatever. And at a tank farm, you might have 100 of them. At a refinery, you might have 25 or whatever. But those tanks need to be inspected. And the way the industry operates that inspects those tanks, and by the way, the industry is populated by many small companies who do the same thing the same way, is they need the tank to be drained. And then they enter that space and they conduct, a physical inspection of the structural integrity of the tank. And that may take them a week or 10 days. And then they're done. They provide their report to the refinery and they charge $20,000 for their service, roughly, right? Well, the problem is that having that idle tank costs the operator of the refinery or the tank farm another $80,000 for having a tank be empty for a month or so. So the actual cost of an inspection is about $100,000 a pop. So guess what? In a lot of cases, they don't get inspected very frequently, right?
Sure.
Which is not good. So I didn't know any of this until I met a gentleman in Houston who had built a submersible robotic wall crawler. It had all the ultrasonics and all the GPS technology built into it. It was the size of a small car. It was a sizable robot. And he had demonstrated it by inspecting a tank at a mobile oil refinery full of diesel fuel. And he inspected this tank in 3 days without draining it. And he did a highly precise inspection. And so this thing worked. It was proven. And he had tried what everybody told him to try. He tried to license it, sell it, raise money, a joint venture, whatever. And and just was unsuccessful. Not because the technology didn't work or wasn't ready. It was because just, I don't know. He was
Feels
just,
super nichey. I mean, I don't know how many people need
well,
those kind of analysis or diagnostics. It sounds really cool, but I think part of the problem is it's very nichey, I would think. And
it's
what's the
actually,
market size?
I don't remember, but it's a huge market, because think of all the huge ports where they have these storage facilities right down the street from me here. There's an El Segundo refinery
Mm-hmm.
where I don't know how many of these things. It's a big market, right? So what we said when I met this guy and he told me about his robot, I said, well, instead of doing what you've been trying to do, why don't we start acquiring these tank inspection companies? And they were relatively small companies, maybe doing 20 million in revenue or 30 million or 40 million. And each one that we acquire, we will empower with this unfair advantage in the form of this robot that enables us, since we're gonna acquire the company, it will enable us to inspect a tank without draining it. So number one, we're gonna take share from all of our competitors. And oh, by the way, number two, we're gonna double our price. So not only are we gonna grow the top line, we're gonna improve our profitability. And the intent here was to do a roll-up of several of these tank inspection companies and empower each of them with this robotic solution advantage, right?
Right.
So there's an example of a commodity business. Everybody inspects the tanks the same way. And as a result, there are many of them, and they are acquirable on attractive terms, because by definition, they're sort of they're an undifferentiated competitor, right?
So now you brought differentiation. So where did this story end? I mean, did you guys sell this? You rolled it up and created all this value. What happened?
Yeah. Well, that made so much sense to me. I thought it was going to be our first deal. It was just, to me, it was a no-brainer. But what we actually did at the same time, we were pursuing another deal. And to my surprise, when I set off to do this, I thought, okay, well, most likely, if we don't want to go up head-to-head with all the VCs, most likely we'll be dealing in industrial and manufacturing technology like that robot. Mm-hmm. So we had a technology in robotics. We had another one in materials. But the deal that proved the strategy was actually in software and digital switching. And it was in the 911 industry. And so the technology was a state-of-the-art system for managing, for the operator to manage an emergency. So they had 3 computer screens in front of them, and they're using the software to reroute to more pressing emergencies, the EMS, fire, and police. So that was the software technology, and it was slowly progressing. And what we ended up acquiring was the operating company was the only manufacturer of digital switches for the 911 industry. So our software was the best front room in the industry, and a company we acquired was the best back room in the industry for routing huge quantities of data through their digital switches. And we acquired these 2 companies. It was a $30 million deal funded with $12 million in equity by a group that is today called Apex. They were Alan Patricoff and Associates. And then 5 years later, we sold it to Golden Gate Capital for $85 million. So that $12 million investment exited at 7 times our money. And this was just our first attempt to demonstrate that this could be done. And right. So I did that some years ago, and I've been doing other things since then. And all this time, it's been nagging at me that my friends on Wall Street were mistaken, and that not only can it be done, but it can be done very profitably, and it can be pursued as a scalable, replicable model. And that's what Technology Capital Partners is today. This isn't just let's demonstrate it. It's been demonstrated. Now it's let's do this on a recurring basis.
So you have a proof of concept, but there's going to be naysayers out there, right? Because again, they have their approach to right. funding opportunities, to looking at certain opportunities versus others. So why do deals this way? If someone is an antagonist and doesn't believe in it, what's your elevator pitch to say, this is the reason to do deals this way, this is the new way?
Sure. Well, the most important piece is that we think that this approach creates a disconnect in the typical risk reward expectation, right? So everybody knows if you're willing to take a higher risk, you should expect a higher return.
Sure.
So typically in venture capital, you have a higher risk situation and a higher return in the long term versus leverage buyouts, where you're acquiring an existing operating business and you're going to try to make it more profitable by making it more efficient. In our scenario, what we believe is that we can capture the lion's share of the venture upside from the technology while eliminating the lion's share of the venture risk, because we're going to acquire a company through which to commercialize it rather than raise venture capital, which is a time consuming process in its own right, to then build a company from scratch, which is another time consuming process. So the primary reason to do this is that we maintain that it has greater upside potential that resides in the ability of this technology to advantage an existing product or service, and it creates thereby great growth potential for the companies that we acquire, or companies. And from the perspective of the investors, we are creating what we believe to be legitimately proprietary deal flow, because if you think about it, we're looking to partner with underutilized technology to acquire companies for whom there aren't a lot of other acquirers, because they're not growing very fast and they do the same thing everybody else does the same way. So we think that we can obtain control of these two pieces and put them together on attractive terms, and drive the profitability, both top line and the cash flow of the combined entity very aggressively, and thereby create, outsized risk-adjusted returns.
How open are these entrepreneurs or business owners that have a $50 million business to doing a roll up or taking part in what you guys offer?
Well, that's very interesting, because remember, these are operating businesses that we want to acquire. They could be as small as 20 million, as big as 150 million. So think of 50 to 100 as sort of our ballpark in terms of revenue. And these are operating businesses that, like I described before, they are undifferentiated. They do the same thing the same way everyone else in their field does. They don't have any particular advantage. So when we approach them with, as Bain Capital called it, the silver bullet, right? We call it the needle in the haystack, but we walk in and we demonstrate the potential of this technology to disrupt their industry. And our interest, again, is we're not there trying to convince them to license our technology or acquire. We're not selling technology, right? Which is what I was observing going back to my Princeton days. I was watching us going sort of hat in hand with these very compelling technologies, trying to convince somebody to acquire it or to license it. And our mentality is, let's not be a seller, let's be a buyer.
So, Michael, again, I want to go back to the entrepreneur. I imagine there's some people that built this with their sweat equity, their energy over a period of time, and maybe it's a great cash cow for these people. So, again, why sell? If it's not broke, don't fix it. But what do you bring to the table where these entrepreneurs have a great lifestyle? I suspect. Look at the opportunity and say, yeah, I want to dive into this because maybe I'm making Y, but it could be an X. I mean, I'm trying to figure out what's my motivation for jumping into bed with you guys.
Yeah, there are a couple of things. The first is that they're in an industry where they don't have an advantage, right? They're doing the same thing everyone else is doing in the same way. The second dynamic that's at work here is that if Mr. Smith, let's say, recognizes the strategic relevance of this technology, and he understands that we're not trying to get him to license it, if he's not interested, but we acquire Mr. Jones' company, all of a sudden it creates this dynamic,
this
where
imbalance.
Exactly, right? So company A is if we acquire company B, company A's prospects are severely diminished. So not only is that something that concerns him, but also if he really believes the potential of this technology to explosively grow his business, he wants to participate in that. And not only that, but his management team, for the first time perhaps, all of a sudden they see themselves as having the silver bullet that they've never had before, that will enable them to explosively and very profitably grow this business. They all of a sudden feel like this business that was an also ran like everybody else, all of a sudden we're gonna grow this company very rapidly and very profitably, because we do have an advantage for the first time in many cases.
Right. And so for TCP, again, you guys come in there, you guys roll things up at some level. You're giving technology components that they currently don't have to give them perhaps an unfair competitive advantage. But as you go forward in time, in signing these deals with TCP, is it understood that they will sell or go public to create the value you guys are looking for? Or what does it mean if I'm a guy that's running $100 million business? What should I anticipate in 5 years?
Yeah, well, that's absolutely our objective is to very rapidly and very profitably grow this business and then exit. And the existing man, and that's another thing is that we believe that by virtue of this disconnect in the risk reward profile and the potential for very profitable transactions, that this makes it even more doable for us to either retain or attract management talent, right? And so the owner wants to participate, the management team is reinvigorated, the customers all of a sudden have a solution they never had before. It really is a win-win-win for everybody. The technology gets commercialized where otherwise it's been struggling for maybe years. This operating business, which is an undifferentiated competitor, all of a sudden has this unfair advantage. And we as investors are putting together deals that we think will create very attractive returns for ourselves. Now, it may be that we exit by selling to a strategic buyer, or maybe we exit by selling to another private equity group that wants to take it forward. So our exit doesn't necessarily mean, the exit for the existing management team or the owner.
Right, right. Yeah, it's very interesting. So, obviously behind any great idea or strategy is an equally great team, and you're fired up, you're enthusiastic, you have phenomenal pedigree with Wharton and Harvard for sure. So talk to us a little bit about the team at TCP that you've assembled to move the strategy forward.
Sure. Well, like I said earlier, when I first, because of Bain Capital, I decided to pursue this idea on my own, and all the naysayers that I came across, there was one gentleman who was not a naysayer. And his name is Steve Hutchinson. He was in New York, and he was actually at one point the co-head of, there was a firm called Weiss Peck and Greer, which was a private equity group, which was acquired. And then you may know it was rebranded and relaunched as Lightspeed Ventures, which is a huge Silicon Valley venture group up there today. Well, Steve used to run their private equity arm. So Steve was one of the very few people who didn't think I was crazy, right? That this made a lot of sense to him. So in terms of my colleagues who are involved in what we're doing today, I've teamed up with Steve. I have my buddy from my Wharton days, my McKinsey GE Allied Signal guy who took me into this incubator. He's my East Coast partner. And then I've got two gentlemen in Las Vegas, one of whom was the former head of GE Capital's West Coast office. And the other one is a former attorney and investment banker. He was a partner and a managing director. And he has a particular skill set in medical devices and the oil patch. And so I'm the managing partner. I'm the one that's doing a lot of the legwork here in Southern California, in particular, sourcing the technologies. But I've got a team of really seasoned private equity experts. And so, when I did this the first time, I teamed up with a guy I didn't know very well, but this is a group I do know well, and it's a very compelling team.
And that's, your team is a force multiplier. You got a super deep bench, a lot of experience. That anybody in this side of being acquired would have a lot of confidence in the team on your side of the ledger, shall we say, and the ability to execute on the vision. Because that's obviously the way you get companies is they got to believe at the end of the day that you have a track record or a team that can deliver. Just like when I'm raising money for my startup, what's the investor looking for? The team I assembled and our ability to execute on the technology, bring it to market, and hopefully sell it. So as we go through this conversation, what are you looking for in particular, specifically, and how can the audience of Beyond support your efforts?
Yeah, I think what we're looking for, and this is how, I've spent this past year or so reassembling my team, establishing relationships with sources of technology, organizations whose mission, either directly or indirectly, relates to commercializing technology, as was the case with us in Princeton. So as you would expect, we're talking to the technology transfer offices at universities. We're talking to innovation centers. We're talking with corporate labs and angel networks. The technology comes from all different directions. So I've spent a lot of time this year establishing this ecosystem with organizations who can refer technology to us. And remember, the technology we're looking for, and in fact, on my LinkedIn page, there's a one-page technology screen, and at the top of the list is it's ready, right? If it needs any time or any money or any approvals from the FDA or whatever,
Early stage.
It's too early,
Yeah,
right?
yeah,
And so we are looking for that technology that's fully baked and has been struggling to find its way into the market. And we believe that we represent sort of another arrow in the quiver of an entrepreneur, where the mentality is, let's not build it if we can buy it, right? And this is such a different perspective on commercializing technology, because technologists are so used to sort of, they're trying to raise a little bit of money at a time. They're trying to, cover their overhead and pay for a few employees and so forth. And all of a sudden, they will find themselves in an operating business with doing 75 million a year in revenue already, where they are no longer out there trying to raise $100,000 at a time to continue to advance their technology, because it is ready, and they can develop 2.0 from within an existing business that serves as the launch pad for their technology. So one thing I neglected to mention about the team is, because there is so much of this technology that we describe, I have internships actually that we've established with USC, University of Southern California, as well as UC Irvine. And so we've got PhDs and MBAs working at each of those institutions that are sourcing. They're doing what Bain Capital told me to do when I was in Princeton. They said, find the technology, qualify it, strategically position it, and then let's talk, right? So
right.
that's how our interns are contributing. And so to answer your question, people who are listening to this conversation, who either control technology that fits this definition, it's ready, it's struggling, it's disruptive, and it applies to fragmented markets. We want to talk to people like that. And also, maybe they don't control technology like that, but they know somebody who does. We would love for them to introduce us, and we'll make it worth their while if they do that.
Sure. Exciting, Michael. This is a unique approach, a unique paradigm, and definitely value creation. I know there's a lot of businesses that are struggling to go to the next level, and it's a slog, and to have a competitive advantage and bring differentiation in means a lot to a lot of businesses. So where can they learn more about TCP and yourself in particular?
Yeah, I think the best place to go is just to my LinkedIn page. You'll find my profile. You'll find 3 documents there. One is our technology screen that I mentioned earlier, which is just 1 page. The second is a 3-page document that describes our strategy. Why do we think this way, and what are the benefits of a lot of these questions that you've asked? And then the third 3-page document is our team and our internships. And so that's the quickest way to understand why we think this way and how we might work together.
Outstanding, Michael. Hey, man, I really enjoyed this conversation. A unique, innovative approach. And to the audience, take advantage of it. Connect with Michael on LinkedIn. Michael, thanks.
My pleasure. Thank you so much, Ben.
All right, take care.
You too.